A few good real estate investments can make the difference between a nice wealthy early retirement and working for the man until you are 65. Of course, this takes a great deal of preparation, planning, and careful deliberate choices. It really is possible. If you're curious about how real estate investing can get you to early retirement, well, you're in the right place. Just watch this. Welcome to Knowledge Pilot. So, this is where it all begins. Step 1. Add up all of your expenses. Before you can think about retiring early, you need to take care of your debts or pay them off. It won't work to retire with a lot of high-interest consumer debt. Pay off your credit cards and student loans at the very least. Once you're out of debt or have at least eliminated the high-interest debt, you should figure out how much money you need each month. How much money do you need to get by on a daily basis? In other words, how much money will you spend each month to keep the living the way you do now? Figure out how much money you need to replace with your retirement income each month on average. Here's your challenge. Keep track of everything you buy for the next 4 months. At the very least, your goal should be to earn enough in passive retirement income like rental income to pay for your basic needs. Step 2. Save up about 10 to 20% of the property's price as a down payment. If you want to save this much money, you need to make it a priority. If that means you have to cut back on vacations, get a part-time job, or cut back on other expenses to save a little more, then do it. Use this time to take control of your budget, limit expensive purchases, live within your means, and put all of your efforts into paying off any high-interest debts. Most lenders require a 10 to 20% down payment every time someone wants to buy a house. Normally, buying a home for yourself as your primary residence, you could put as little as 5% down. Although, it's better to put down a little bit more money as a bigger safety net. But in our case, remember, we are wanting to buy a property that we rent out so we can retire early. So, for real estate investment properties, most lenders will ask you to put down more money, sometimes up to 20%. Now, once you've got that down payment saved, the next step is to buy a property. This is one of the best ideas to maximize your passive income potential. Step 3. Buy a multi-unit building that you can move into yourself. A multi-unit or multi-family home is a property up to 4 units. Any more units may result in more complications when getting a mortgage. 4 units is ideal because you could live in one and rent the rest out. Aside from the obvious benefit of getting rental income, buying a multi-family home can help in several other ways. 1. Lower vacancy risk. With multiple units, you have the potential to earn rental income even if one unit is vacant. This lowers your vacancy risk as you still have the other units generating income. 2. Lower expenses. When you own multiple units in the same property, you can spread the expenses over the multiple units. You can also self-manage the units because by living there, you can more easily keep an eye on the place. This can help lower your overall expenses, which can increase your net rental income. 3. Appreciation. Multifamily homes can appreciate in value over time, especially in areas where the demand for rental properties is high. This can increase your equity and provide long-term passive income if you decide to sell the property in the future. You should consider factors like the location, property condition, rental rates, and local regulations before making a purchase. Additionally, you will need to manage the property, handle tenant relationships, and ensure that you are meeting all legal and financial obligations. Step 4. Buy a property that needs fixing up. Fixing up a property is the way to go if you want to not only raise its value but also make more money in rental income. Most people choose the ones that look a little old. If you're just getting started, you shouldn't take on too big of a project. From start to finish, anyone should be able to do this in less than a month or 2. Be careful though, buying a property that is too old and run down could run the risk of you missing some hidden issues during the renovation. This may result in you getting late night calls from renters to fix problems that you didn't know were there when you first bought the place. These expenses will eat into your bottom line cash flow. But there's more to it than just regular maintenance. If you put money back into your property, it will be worth more and you will get more rent. You won't always have the same renters. When you sign new leases, inflation will be a factor. And you can also charge more rent if you improve the property and make it more desirable to potential renters. Your investments will make you more money every month, and they will also add to your overall wealth. Remember that investment properties bring in money and increase in value over time. When you retire and sell the house, you'll get the capital gains. The more you put into it while you own it, the more money you will make in the end. So now, what do you do once you're done fixing it up? Step 5. Rent out other units. This is where the cost of the other units should ideally cover all of your property expenses. This includes your mortgage, property taxes, insurance, repairs, maintenance, and anything else that comes up. You're now going to do what's called a cash-out refinance. This means your bank will give you a new loan based on the new, higher value of your property after you fixed it, and you profit from the difference in cash. Here is an example. Let's say you find a property with 3 units that you can purchase for $400,000. You put down 20% for the mortgage down payment, which is $80,000. This means you will need to finance $320,000 with a mortgage. Once you purchase a property, you estimate you will need to spend $50,000 in renovations to make it rent ready. This brings your total investment in the property to $450,000. $400,000 purchase price plus $50,000 renovation costs. Once the renovations are complete, you rent out the other 2 units in the property for $1,500 per month each, which, let's say, is a realistic rent for the area. After accounting for expenses like mortgage, property taxes, insurance, and maintenance, you estimate that you will have a net monthly cash flow of $100. This is still okay because your tenants are paying your bills, including the mortgage. After a year or so of renting, you decide to refinance the property based on its new value. Let's say the appraised value of the property has increased to $500,000. You decide to refinance the property for 75% of its new value, which is $375,000. This pays off your initial mortgage of $320,000, and you are left with $55,000 in cash from the refinance. You can then use the $55,000 to repeat the process and buy another property. The goal is to build a portfolio of rental properties that generate passive income. It's important to note that this is just an example, and the success of this strategy depends on many factors such as market conditions, property location, renovation costs, rental rates, and more. Therefore, it is important to do your due diligence and work with experienced professionals such as a real estate agent, property inspector, contractor, and lender. The truly powerful thing about this strategy is that if you keep taking this extra rental income plus whatever extra you can save and continue putting it back into more real estate, you will start to see these numbers grow very quickly. Because now, in addition to using your own equity to buy more properties, you'll also have extra rental income every month that you can use to invest in even more real estate. This is the power of compound interest. Start with your foundation, but always be looking to add to your real estate portfolio. Reassess your income needs if things change. Did your lifestyle change, or did you change your mind on how you'll live your retirement? Adjust your real estate portfolio. If you need more money, you'll need more cash flow, which means you'll need more properties. If one of your properties isn't doing as well as you thought it would, then sell it and buy another one in a better area. It's about being flexible and always taking a look at your situation. Even if you make a plan for the next 5 years, if things change, you should make changes so that you are always on track to retire early using the money from your real estate. Bottom line, the key is to stay organized. If you work hard now, you can retire early with the help of real estate. Do your homework and figure out how much money you need each month to live and what it will take to get there. How many properties will you need to own? How can you make the most money with as few properties as possible? Check your situation often. Work with experts to make sure you're on track to make enough money to live the life you want without going to work from 9 to 5 until you're 65. Good luck! You've just learned how to retire early through real estate investing. We're going to wrap things up here for today. We hope you liked this video. If you want more information on real estate investing, check out our other videos on the screen. Thank you for watching.